Welcome to another Wednesday night live. You'll notice we're on a little bit early tonight. For those of you watching us on video, decided to hop on. We had some time. It's my son's birthday. Would like to get home this evening and celebrate with the family. So we thought we'd hop on here and do what we do, which is answer your mortgage and real estate questions, update you on the economy, have some fun. Josh, you weren't here last week. You missed a fantastic show.
I was enjoying a friend's 50th birthday, so we got to celebrate. I enjoyed a birthday last week. You're going to bail out and enjoy a birthday this week.
There we go. A little bit different celebration, I would imagine, with a 11-year-old and a 50-year-old. But
your child is probably more mature than the 50-year-old I was golfing with.
That's impossible. If we know which child this is. Anyhow, we appreciate you being here. If you'd like to start putting questions in the chat, it helps the conversation flow a little bit better. We always like to take a look at charts to start these shows. If you're on the podcast and you're listening to this, just know that we also upload this video to the podcast, so you can actually watch it, see the charts, to know exactly what we're talking about. But with that said, Josh, we dropped an episode last week on the podcast about self-employment. The video is probably our worst performing
our
video,
least popular video ever
in 3 years of doing this. And it's because there's a small subset of our audience that actually listens to or is self-employed rather. But that said, if you are self-employed or you're thinking of going to the self-employed route, want to know how that affects your ability to buy a home, definitely check out that episode. It's a good one. It goes over the details, but it will do well over time. It's just not one of those videos that performed initially. So with that, Josh, let's dive into some charts, take a look at what we always do and keep the conversation moving along. So one thing, we started doing here is the title of the episode, this video is "The Housing Market is Shifting Fast in 2025." And with that, what we're seeing is a lot of buyer demand. We're seeing buyer demand subside a little bit just because of where rates are and where, inventory, so on and so forth. But with that said, we're not seeing huge drop in prices nationally. And we're not seeing, you're going to see from these charts, we're still seeing some year over year increases in certain metrics versus the last couple of years, even in the environment that we're in, which I think is important to note. So, Josh, with that said, this is the S&P or CoreLogic's Case-Shiller Index, and this is from March. Why am I getting dings in my ear, Josh? Is there a reason for that?
I didn't make that noise. It was not.
You did not ding in my ear. There we go. All right, we're going to turn that off. Anyhow, this is from March, the way they aggregate the data. So it's a little bit old. In fact, some of their newer data is coming out today with this information from April. But nevertheless, just showing home prices basically from March of 2024 to March of 2025. We hear a lot of these markets out there, Josh, tanking. There's homes sitting on the market. People are giving them away. And when you look at the indexes, especially when you look at, look at the national price home index, but when you start looking at the 20 city composite and the 10 city composite, you see that, home prices are still strong.
Well, Jeb, we hear from people in the comment section all the time, in my neighborhood, they can't give them away. They're piling up. Be careful with anecdotal evidence and your ability to look locally. Not that it's wrong. It could be right, depending on where you're at. But I just know anecdotally for me, have an offer got accepted in Florida in the last week, and they were two properties that they liked, and they couldn't come to an agreement on the first one. They were able to come to an agreement on the second one, and both of them right in the ballpark of asking price. That's Florida. Okay, Florida, where they're giving away houses, right? They didn't have to go over. They didn't have bidding wars, but the one seller just wasn't willing to cooperate. They found a very similar home. They negotiated a price. So they had a good time in terms of getting in at a price they thought was fair and reasonable. The other one was in Tennessee. Very nice new construction home, and it was 7 days of back and forth. I believe we had 4 counters back and forth before they did come to a middle ground that was below the list price. But when we're seeing that in different parts of the country, that's what's common. It's not, hey, I'm rolling in, I'll give you $8 for your house. It's more along those lines.
I'll give you $9.
But remember, what I'm saying is this is all, even my stuff is anecdotal. I see a lot more negotiations up close around different parts of the country than almost anyone that you're going to talk to. So just be careful when you, as someone is looking at Redfin or looking at Zillow or seeing these things. You really want to see someone who's actually seeing deals. And it can be like even an individual realtor, Jeb, like a big office like the Coldwell Banker that you used to work out of over there. Any agent that is super busy right now would only do 2 or 3 sales last month, but you guys have sales meetings. You sit around and talk. They at least have a feel. Like that's part of the job of being a realtor and networking. Going, what are you seeing with your listings? How is this market going? So you need to know boots on the ground what is happening in your market. You need to know someone that has their hands on that data and can explain it to you honestly and accurately.
Yeah, and then this chart is basically just a breakdown of the 20 city composite. It also has the 10 and the 20 at the bottom, the national at the bottom, and it just shows, month over month or year over year rather than going back to January, February, for March, so on and so forth. So not going to dive through it. You can take a look at the chart if you're interested in it. But we're going to take a look at inventory. So inventory is something we follow closely here, and we're back to 2019 levels and still clowning. We're still clowning around here, Josh.
Don't clown
but
anyone.
We're also climbing up to 768,000 single-family homes on the market. That's 1.5% increase this week and 33% over last year. And you can see at the bottom, started to try to just tie in the charts here. So you can see we went from 767 to 787. Whereas last year we were sitting at 594,000. So that's where that 33% increase is coming in. Orange County, we actually saw inventory go down just a tad by a couple of listings. So not even, 0.04% to 4,554 active properties on the market. Huntington Beach down 3.08% week over week, down to 292. Again, we're talking small increases here, but what we will see. But you also have to remember Memorial Day. There's some things thrown into there, that do have an impact on some of these numbers. Now, looking at new listings, we're back above 80,000. This represents a 15% increase compared to the same week last year. However, last year, you can see a major dip, and that is likely because Memorial Day fell on a different week than this year. So you could expect a 15% increase to reverse course next week as we start to get that Memorial Day data in the charts here. So it'll be interesting, again, how these holidays play in, but we are continuing to watch it. Let's take a look at weekly pending sales. So this week, 72,312 homes went into contract, marking a 5% increase over the same period in 2024. Crazy, right, Josh, that we got more weekly pendings this year than we did last year. But again, it's, we're looking at rates probably really similar to where we were this time last year. But we're seeing
five basis points difference, and as recently as like 6 or 8 weeks ago, it was more than 0.25%. It was like a 0.5% difference because rates were higher to start last year and then started moderating. And if you look, Jeb, this chart here, that big uptick in weekly pending sales started about July last year when rates really dipped and ran through August. So anyone that says that this market isn't rate sensitive and there aren't people waiting on the sidelines for a specific interest rate, there absolutely are. So if and when we get a dip, I would expect it to do the same regardless of what season we're in and what normally happens that time of year.
Yeah, so this is weekly, and then take a look here. This is total. So total this year, 414,107. Last year, we were at 403,650. So you could see an increase over last year, but then look where we were 2022. That's before rates went up. You can see how much rates impacted the pending home market, the demand out there at that time. And then as rates started to creep up, you can see what happened to the transactions at that time. That takes us into percent of properties with a price reduction, currently sitting at 38% of active listings, taking some sort of price cut, and that's an increase from last week. And then, Josh, this is an interesting chart. I saw this today as well, and just shows, the share of homes built at less than 1,500 square feet. So back in the 50s, you had almost 100% of properties, 90-something% maybe, that were under 1,500 square feet. And now, less than 25% of homes being built are less than 1,500 square feet?
Yeah, it's a very small number, and that's unfortunate. It's moderating some. So we've seen, Jeb, with the data from the new home sales, the median home price coming down, regardless of what Diana Olick would like to spin that as. That doesn't mean that new home sale prices are coming down. It means that builders are adjusting by making smaller homes and with less upgrades. So hopefully we can start to see that. We've seen you. Christina Smallhorn has a channel about small homes, tiny homes, affordable homes. There is a massive market for that. People want it. So it's not where margin is for builders to make money.
And that's the problem, right? So we look at what builders are building. Builders are trying to maximize square footage, right? And how do they maximize price? They build the most amount of square foot in the least amount of space that they can do, so they can build multiple homes. That's why you get these tall and skinny houses now, these, townhomes that are 3 stories. It's because they can build a lot more of those than they can a single family home with, that's probably more desirable, to be completely honest, but it doesn't maximize profit, and builders are there to maximize profit. So with that, Josh, takes us into something that we've talked about before, and that's the typical age of home buyers at this time.
So it's funny. I threw this in here because we've seen it. We've talked about it a million times. So you can see a drift higher. It dropped a little bit during COVID as some of that, we talked about demand getting pulled forward. People who probably wouldn't have bought till they were 33, 34, 35 took advantage of those low interest rates.
I actually think it's 38 on that one. But if you go back, it says, I guess this isn't first-time home buyers. This is the median age of homes sold. So all the median age of homes sold. Gotcha. Okay.
Yeah. So this is typical home. From or where this is important is we're seeing more demand for renovation loans, ability to fix up some of these old properties. So you're going to see some of the older homes, smaller homes, 30 plus years ago, easier to find a 13, 14, 1,500 square foot home that's going to be priced a little bit better, but it's going to need some work. Now, the age for first-time home buyers, you're right, 38 on the first-time home buyer, repeat buyers at 61. So this number here blew my mind. The median age of all home buyers. So when we look at that combination of 38 and 61, you put them together is 56. That was 31 years of age in 1981. So I don't know about your neighborhood, but it is. As people get older, they're more likely to stay put. Younger people have kids, need more space, get a job promotion, move around. By the time you're 45, 50, 60, you're like, I kind of like this place. I'm going to post up here. But that number still blew my mind that 40 years ago, we were looking at a 25-year younger age. I wanted to throw this in here because this kind of relates to that, Jeb. So if we look at that, this is the demographics are a tailwind to housing demand. So if we look at that, we're in the green circle there right about now. So it shows in this time frame where we're at with people in that prime home buying age. Well, if you look at I drew the blue line on there all the way out to like 2064. You're not really seeing a dip in that. There's a couple of dips around the 2040s and then again in the 2050s. But at that point, it starts falling off. But we're looking at this. I believe they were going to 33-year-olds. So they're using 33-year-olds, i.e. most first-time home buyers. Well, this whole thing needs to get slid forward 5 years. So this big demographic tailwind, if people are 38 instead of 33, the whole list here is about 5 years forward. So there's that piece of it. And then we always hear about when's the silver tsunami coming? When are all these people going to fall off a cliff? Well, those people are going to start falling off of a cliff. But for the next 20, 25 years, we've got plenty of people in prime home buying age coming in to take that over. So what I learned from this chart, Jeb, is somewhere around 2065, I'm going to unload all of my real estate holdings before the population collapses and there's no one to buy them.
2065, Josh. So that's 40 years from now. You'll be 90, what?
92. And
92.
I'm a dump at 92. I will dump my holdings and ring the cash register.
Do you think we're still going to be on YouTube in 40 years?
We couldn't have imagined YouTube 40 years ago. 40 years from now, we'll have the Neuralinks where we can just talk into people's brains. They won't be able to get away from from us. One more last look at this share of U.S. home equity held by people who are 70 or older. It's funny whenever we kind of see these lulls in the housing market. So late 90s, we had more 70-year-olds holding home equity. Right after the spike in 2007, 2008 is kind of when it peaked. But we're kind of at that long-term trend. So old people getting more and more equity over the long haul. So all you got to do if you don't like your station in life, just wait. You'll get older and you'll be one of those folks. So Jeb, is it Friday? Friday, I believe we have PCE coming. This is the Cleveland Fed's nowcast. They're expecting 2.37% year over year and 2.73 on the core PCE. Friend of the show, previous guest, Barry Habib, loves to kind of reverse engineer these numbers and show what he and his team are expecting. Thinks they're going to come in a little bit lower than that, 2.23 year over year and 2.6 on the core PCE. If he's right and it comes in low, do not expect a strong positive response. The market is ignoring all inflation data right now because if you remember, we throw the Truflation in here. We've been looking at it here recently because it has a high correlation to CPI.
It jumped like 80 basis points in like the last 2 weeks.
Yeah, it was at like 1.3 a month ago, and now we're at 2.08. So it moves much faster, and it may be picking up the impacts of tariffs at this point. Thought this was interesting, Jeb. Every once in a while, we're having a recession. Recessions are deflationary. It'll lead to lower interest rates, higher unemployment, all the things that will help the Fed cut. So just this year alone, the first 2 months of the year, we were at about 20% odds. That went up over 62, 63%, and is all the way back down to about 40%. So the moral to the story is this is a lot like the Fed funds futures market, even though this is people wagering with real money at Polymarket. The market's volatile and uncertain at this point in time. So speaking of Fed funds futures, we have a 95% chance of nothing happening at the June meeting, a 75% chance of nothing happening again at the July meeting. And then for the next two meetings, we've got about a 70% chance of a quarter cut at one of those two meetings and about an 80% chance of a 0.25% cut again at either the December or February. So best case, we're looking at a 50 basis point Fed cut between now and the end of the year. The episode you and I recorded today, Fannie Mae came out with their most recent forecast. They're expecting low sixes by the end of the year, high fives by the end of next year. It jives with a kind of a slow move down, but any and all of that is hard to predict. If you see inflation continuing to tick up because of the tariffs, it's going to be hard to see lower figures. Really, the important thing to look in this, that orange up channel, we finally got off the elevator. At least the last couple of days, we're below that orange uptrend in rates. Hopefully that continues. We're going to have some resistance at like 440, Jeb, again at 434. So if you're in the market, this chart is telling us good things in the short run, but there's resistance for it to move much better. So likely to move sideways. Those two folks that I told you we opened their loans here in Florida and Tennessee, both of them elected to lock just to get away from that volatility. You can see Mortgage News Daily, just under 7%. I think we were at 7.05 last week, mid sixes on FHA and VA. That's about where everything is at as of today for most borrowers.
All right. So with that said, where are you guys listening from? Let us know. If you tell us every week, I don't know that we need to know. We're okay knowing, but it's not mandatory. But those of you who don't tell us, that's who we want to hear from. We want to hear where you're watching from. I know we're going to have some. We're going to have some Minnesotas in here. We're going to have some Inglewoods in here.
Minnesota.
Yeah, we're going to have some of those. But where are the creepers coming in? The people that stalk, that don't comment. The longtime listeners, no time commenters. Those are the people that we want to hear from. Anyhow, that is where we're at, Josh. So let's do this and answer a question that came in prior to us ever coming on from TM. So TM wants to know when the Northeast flip is going to flip to a buyer's market. So the Northeast, if you did not know, is still a very strong seller's market. Not a lot of supply, more demand than they have inventory out there, and leading to craziness in many ways. People getting frustrated because their offers aren't getting accepted, so on and so forth. So the easy answer to this, TM, is when you get more inventory than you have buyer demand, but that's not what you want to hear. You want to, at least I don't. It's one of those markets that continues to surprise me to some degree because it's not inexpensive real estate. It is still very, very pricey, and yet it's still crazy out there. Anything to add to that, Mr. Lewis?
Whenever I hear a question like that, it starts with an assumed premise being that it is going to flip at some point. It doesn't have to, and it sure could, and it could do it further out than what we think. I will go back to what we continue saying is interest rates are going to tell the story. Rates high sixes and above will make that happen sooner rather than later. If rates moderate down to 6%, 5.75, I wouldn't hold my
No idea if Josh is talking or not. No idea.
The best part, Jeb,
like,
is you were frozen and it was a look that made it look like you were taking what I was saying very seriously. And then I realized after I shut up that you were not talking.
yeah, you would think when you're in a business and you have fiber optic internet, there would be no issues, but there are issues daily, and might maybe not for long, Josh. Maybe not for long.
Maybe not for long. We may have a solution.
We do. We have a solution.
Going to another building with a better internet provider is the solution. I'm thinking.
All right. So what we've got is Tundi in Little Rock. We got TMs in the mountains. There's a lot of mountains. So that doesn't help us, but we'll just go with the mountains. Let's see here. Eli the Bells. Does that say Eli? Boston, Mass. Terrible. Is that your sports teams are terrible, but what else is terrible about,
I think he's saying the market in Boston is awful. Doesn't like it.
I thought he was talking about sports. I thought he was talking about the Red Sox because I could get behind that. D'Angelo is listening from Kansas City. We got David in the Pacific Northwest, and that's Eli is long. I can't do this. Is a longtime listener. Does that say jerker?
Lurker. He's a lurker.
It looks like a J from here. It looks like lurker. All right. Well, anyhow, that's where we're at. So Josh, do we have any actual questions here?
We have a good one, and you are uniquely equipped to answer it. So what is your recommendation on trying to buy if you already own, dealing with kids and 20 years of
I might quit. I might just walk out of the office, Josh.
Why don't I just talk really loud so you can hear me through the wall and you'll know whether I have what I've said and if I'm done
whoever's
talking.
Listening to this has to be getting the freezing on their side, and they must be like, these idiots have been doing this for 5 years. Can they not figure this out? And
our viewers are intelligent and they understand the limitations of technology, that we are not just pausing mid-sentence. So if you're still here, if you have not all bounced and gone on to better things this afternoon, please confirm that we are in fact not just freezing to one another, but also freezing to you at home.
All right, here we go. We're going to answer the question. Recommendation on trying to buy if you already own. Yeah, I mean, here's the thing is determine why you're moving, right? I think that's the important piece. And figuring out whether or not it makes sense. 20 years of crap is what it is, right? I mean, whether it's 5 years or 10 years, moving it doesn't make it any less just, what's the right word? Less of a hassle. It is a pain, whether it's every 5 years or every 20 or every 30. It's a lot of stuff and it accumulates. My recommendation is before you move, well, once you decide that you're moving, obviously, get a big dumpster out there and start unloading this stuff. Like if you got 20 years of shit in there, you can get rid of a lot of things that you don't need to take to the next house. And I would do that prior to putting my home on the market because it's going to help it show better, less, just stuff in the property, less stuff that you have to move around for photos, for all of that. Now that you've got that out of the house, now get it on the market and then use garage, that stuff as a staging area. But as far as options go with contingencies, I would say it's fairly common in the markets that we're in at the moment to list your property with a contingency that you have to find a replacement home. I think that's pretty, I don't know that it's a standard. There's no standards, but for a lot of the US, they're having similar issues as to what we're having. And that's, yes, there's inventory, but there might not necessarily be something that you're interested in. So list it with that contingency. And then if and when you find the right home, make an offer that's contingent, obviously, on the sell of your home. Hopefully your property's already in escrow at that point, so that it's less cumbersome in the paperwork and all that good stuff, and that makes more sense to the person accepting your offer. But here's what I would tell you not to do. Do not wait until you find the right home to then go put your home on the market. It's backwards, right? It happens. I realize that's how most people want to do it, because they don't want to get their home ready. They don't want to be let down. They don't want a buyer to love their home and feel like they're going to be homeless if they accept an offer. The contingency protects that. But instead of making this entire show about this one question, reach out if you have questions. I talk a lot about this on another YouTube channel that I have. It's called How to Sell a Home. And I talk to sellers about selling property and what they need to do to get it prepared. So if that's something you're interested in, check out that channel. It's still growing. I think we're at like 750 subs or something. So
I have a side business, Jeb. It's not another YouTube channel. I have a side business where I send my wife to your house and she throws away all extraneous stuff within a few hours, and your home is decluttered. And it
might even be stuff you use.
It could be things you use, but she will look at it and determine if it's worth keeping and get rid of it. So
yeah. It's surprising that Josh is still around, if we're being completely honest.
I made the cut.
Yeah. For now. Let's see. What's the big perks outside of a 3% down payment? Did I miss part of a question?
Started with the first question. It's a first-time home buyer question. Does the primary borrower have to be the first-time home buyer, or can the co-borrower be the first-time home buyer? What about a non-occupant co-borrower? Do they all need to be a first-time home buyer? Generally, only one of them needs to be a first-time buyer, but I don't know about the non-occupant co-borrower in terms of qualifying. So when we say first-time home buyer programs, what are we talking about? For conventional, the primary first-time home buyer program is Fannie Mae's Home Ready or Freddie Mac's Home Possible. They both allow you to do 3% down, regardless of whether you're a first-time buyer. They're mainly income limitations. The standard Fannie Freddie 3% down, no income limitations. To be eligible, one borrower has to be a first-time home buyer. So that's the eligibility requirement. But if we're talking about Home Ready or Home Possible, where they get rid of all of the loan level price adjustments, the things that can make a conventional loan for a lower credit score, a mid-tier credit score, a much higher rate, those are capped or eliminated depending on where you fall. So that's the biggest benefit. You can get reduced MI, you can get eliminated loan level price adjustments. But for the most part, when people say, I'm a first-time home buyer, what are the great programs I get? It's not free money. They're not giving you a big credit. It's basically just some tweaks around the margins that will get you better terms.
All right. Good. Let's go with this from Anshu. Any scope of refinancing in an ARM, 30-year fixed on 6.5 with no cost in the near future? So 30-year fixed in an ARM or a 30-year fixed? I'm not sure I understand.
I don't know a lot of Anshus, so I'm assuming this is the one that we've spoken with, and it's high, slightly elevated rate, but not the best rate in the world. And it's a relatively large loan. So it doesn't take a huge amount to make it worth doing. So do I think it's possible? I do. I think we've got a giant cloud hanging over what happens with interest rates in the form of tariff uncertainty, because every time we get close to seeing them, they get kicked further down the line. You know, we keep hearing these negotiations are going. Well, here's this number, and now the number. So you got a moving target. We're always kicking the can down the road in terms of timing and level of those. Until we get clarity, I don't know that we're going to see rates move lower. All of the underlying fundamentals of the economy tell us that interest rates should be moving lower. But Peter Bookvar, one of the guys that we follow, who is probably the best in the business at sitting on earnings calls for public companies and hearing what they're talking about, what are the keywords that keep coming up in their conference calls, all of them are looking to pass on the increased cost of the tariffs as much as possible to the consumer. and they're all, for the most part, having trouble passing those costs on. So there's this tension between weakening consumer and what they will pay and higher expenses due to these tariffs. Until that clears, I don't know that we're going to see a big move lower. So fourth quarter of this year, hopefully first half of next year, we'll get some of that clarity. But what we won't do, Jeb, is we won't say anything about President Chaos again. It makes a certain subset of people really angry.
Oh, well, here's the deal. We're going to have a mid-year forecast coming out. We've done one the last couple of years, Josh. Are we ready for a mid-year forecast coming out at the end of June?
I'm going to say it's just going to be it's going to be like an Instagram picture post. It'll just say uncertain, future uncertain. It's like the magic 8-ball.
Just have it on there and just don't say anything for like 10, 15 minutes, and that's the episode.
Unclear. Check back later.
All right. So for those of you listening at the moment, it's 5:11. We've already been on here 30 minutes. We started the show a little bit early tonight. Assuming there's still people here at 5:30, 5:40, Josh will keep it going. I've got to jet a little bit early this evening because my son's birthday. My middle son, it is his 10th birthday, or 11th. He's 11. He would be pissed that I said 10. He's 11, and he wants steaks. And Josh, we've recently gone away from the Traeger and we went charcoal. We got tired of the Traeger. And so charcoal is what it is. And it's just flavor's way better. Just takes a little bit longer. But that's where we're at. So
Jeb's a searcher. He's just constantly searching. So he switches, turns over solutions, and it's going to be this, then it's going to be that. Let me know when you find the destination.
I got both, bro. I got both. I just, my $60 Weber, just the flavor tastes better than my $1,500 Traeger. Just throwing it out there. Chung, listing my house for 65 days, 20 showings, but no offers. Completely frozen market, Roseville, California. Here's the thing, could be a number of things. I've got 4 listings on the market. One's coming on the market tomorrow. Well, it's coming soon, so it'll be coming on. Out of the 4, one's under contract with multiple offers. The other 3, one again isn't really counting. So 2 out of those 2, one we've had a handful of showings on, and we don't have any offers on it. There's a couple in that neighborhood. And then one is a little bit further out in Temecula, and it's getting not as much activity at all. We've got a showing schedule for tomorrow, but just some areas take a little bit longer. But when I looked at the days on the market of that property that was outside the area, it was quite a bit higher than locally here anyway. So it was almost expected that you were going to sit for some period of time before the home sold. And then they didn't really sell that much less than the asking price. So I don't know what Roseville looks like as far as days on market, what the median or the average is in that market. But it's something to pay attention to, especially at your price point. And then pay attention to, what's happening with the comps around your houses. Is everything in your neighborhood, in your area sitting, or are you the only home sitting? If you're the only home sitting and everything else is moving, then it's probably a price problem or a property problem. But if everything, I say everything, put that in quotations, is in a similar spot, then it's probably not you. It's probably them. Remember what they used to say to you, the guy or girl in high school? It's not me.
What do we talk about? We talk about everything being local. So what is happening in this locality? So friend of yours, Jensen, who bought 18 months or so ago in Citrus Heights. Citrus Heights is 4 miles from Roseville. So these are all Sacramento metro area. And what was the big driver of the run-ups in values there? People getting priced out of Silicon Valley and going out there. Well, Silicon Valley market is suffering right now. So if that market is suffering because the Silicon Valley economy is a little uncertain or down, it makes sense that it would stretch out there. So Jensen got an awesome job in Colorado. They moved, bought a bitchin' house, and they're trying to sell the house in Citrus Heights and having the same exact experience here. So it could absolutely be the market. So you sit here and say, we've talked about the Bay Area market being very volatile and having these dips and then coming back and recovering 2 years later. The past results do not guarantee, are not indicative of future returns, whatever that saying is. You can't guarantee it's going to happen, but we have seen it happen the last 2 or 3 times. Sure. It's just a more volatile market. And I think you're seeing some of that extend to the Sacramento metro.
Agreed. Raul says, if a property is contingent on seller finding a replacement, how much longer on average does that take to complete in order to close the deal? It depends. Depends on what that seller is looking for in another property. And that's part of something that you need to take into account if you're a buyer that's going to make an offer on a property that's contingent and accept an offer, or come to an agreement with a seller who is looking for a replacement home. It's important to know what they're looking for. Like, your agent should be asking them, hey, what is it that you're trying to find, price point wise, bedroom bathroom count, neighborhood? Like, are you seeing things out there? Have you seen things? Because if they're completely unrealistic in what they're looking for, then it may never happen. But more often than not, sellers have already found properties that they're interested in. They've been making offers, or they've been waiting to find an offer on their property before they make offers. So generally not that much longer. You just got to find again, another seller who is willing to work with a contingent buyer at that point, because they will be contingent on selling that property to, say, you in this case. So it all needs to fall into place, but it's something that happens routinely. Just make sure you have a professional on your side, somebody that understands how to structure this, is able to have those conversations so that you can ultimately get to the finish line. And if you need that person, there's a link actually scrolling the bottom of the screen right now, and you can get in touch with Josh, or you can get in touch with myself. Happy to refer you to an agent anywhere in the country that can help you through that process. But you can also talk to Josh about the pre-approval process.
On either side of the equation, Jeb, representing a seller who wanted to be contingent on finding their next property, or a buyer who was under contract with a seller contingent, have you ever had a really bad experience, something that drug on, or someone who just gave up and said they couldn't find a home and is just staying?
Yeah. I've never had a really bad experience from a seller perspective, in the sense that they weren't able to find anything. My sellers they've always been able to find something, and the buyers, fortunately, have always stuck around on the listings I've had. I have been representing a buyer before that we were under contract, and the seller decided not to sell, and we had to go back to market and look for something, and they ended up finding something. So it does happen. But what I will tell you is, a home sold in my neighborhood probably 2 years ago at this point, and supposedly the seller of that property was never informed that they needed to put a contingency on their property when selling, because supposedly the agent didn't know, or didn't put whatever. But the buyer said they had the conversation, or the seller said they had the conversation. Well, they didn't put that verbiage in there. And guess what? 30 days, that seller had to be out of that property. Didn't have a house. It was a nightmare. And this is an agent that sells a lot of homes. So just know, you still need a professional, but you need to also verify and check that the language is there that you think is there. Anyhow, D'Angelo, looking to become a first-time homebuyer early fall of this year. Has anyone done business or can tell me about Roush Coleman Homes? Coleman Homes. I saw, where was he earlier? I saw he was in, what market was he in?
D'Angelo already answered. I'm like, you know D'Angelo? You follow him?
No, I don't know
around?
D'Angelo. He's in Kansas City, Missouri. So I don't know if they're a Midwest builder or if they're a national builder. I've never heard of them, but that doesn't mean anything. So if you have any advice or anything for D'Angelo, drop it in there. And then this is a really good time to put questions in if you have questions, because we are sitting here with no questions to answer. So if you're somebody that's like, well, I'm not sure if they'll get to my question, now's the time. And also, if you haven't done so, hit the thumbs up if you're finding any value. If you haven't done so already, if you're just one of those people that are lurkers and don't subscribe to channels, we would appreciate that as well. We're continuing to try to grow the audience here, and we appreciate you.
I just did a quick search on that builder, and do the same thing, D'Angelo. Go into GPT, ask it to do deep research and tell you everything that it can about it, and cite it and give it back to you. The thing, any type of research that you're doing on that, and reviews and reputation, you almost want to make sure that if there's only negative stuff out there, it's probably only negative. But just remember, no one loves leaving reviews more than angry people who like leaving bad reviews. So if there's a number of bad reviews there that you don't like, there should be a large number of positive reviews to offset it.
There you go. That's good advice. Good advice. Josh, we are floating here.
Sounds like it's birthday steak time.
Birthday steak time. I'm not going to bail quite yet. I'm going to give the audience a little bit more here. Josh, you're out next week. What week are you out again?
I think 2 weeks.
2
It's
weeks.
the 12th. Going to be on a plane to Detroit Rock City.
There we go. I have a question for those of you listening then. Since you're not going to ask me questions, I'm going to ask you questions. What is something you would like Josh and I to cover on the podcast in detail? I feel like we've been doing the podcast now for over 2 years. We've covered, I feel like, everything.
Over 3
ad
Jeff.
nauseam.
Episode 173 was recorded today.
Was
That's
it?
3
But we
plus.
didn't start on that. We didn't start on YouTube for. It's only 2 years on YouTube. PMI. We could do PMI. That could be a decent episode. Talk about mortgage insurance. Have we talked about mortgage insurance? I feel like
I'm
we have.
sure we did in the first year.
I feel like we have.
Maybe we just start back over with Mortgage 101 since we didn't really cover it after the first year. We went through almost everything that first year.
All right. Well, we'll see. The power of now. We could cover the power of now, Josh. When do you guys think rates will come down? Well, we're going to be talking about that a lot. Not soon. They're not coming down soon. Soon meaning weeks. I don't know, Josh. You see
We
world
literally answered this about 20 minutes ago. Until that cloud of uncertainty from tariffs goes away, that we either have them in place and know what they are, or they've all been negotiated and settled out and we've stopped talking about it, we're not going to have lower interest rates. So if you can tell me when that ends, I can tell you when you have the potential for lower rates.
Somebody said property taxes in states like Texas. We could talk about property. We've never talked about property taxes. I mean, it varies by state, but we could do an overview of property taxes, how they impact, mortgage, when you purchase and going forward, something you need to pay attention to. 3-putt bogeys, long time no see. Bought my house in Dallas coming from OC in 2022. The city has had a lot of growth issues and the market sucks. We've had our house on the market for 45 days and finally got one bite. So that one bite that you got, is it?
Did you get them on the hook? Did you reel them in?
Yeah. Was it where was your original list price? Like, tell me some things, right? Original list price, what you accepted, and why are you selling after 3 years in Dallas? Are you staying in Dallas or are you moving somewhere else? These are all things I'd like to know. Said only reason is because we have an assumable loan at 4.65. That's a good reason. I actually have a VA loan on one of the listings I have right now at 2.75%. The caveat.
What's the gap? What's the equity gap? They got
$550,000.
Yeah.
Or $500,000. So maybe you can get a second. It's a VA. Maybe you can get a second behind it. But either way, it's a hell of a first on it. So, all right. 3-putt bogus is not going to answer my question. So we're just gonna sit here and stare at one another, Josh, through the camera. Dead silence.
Usually there's a rando strange question over here that we could go back and answer, but I'm not seeing anything. So apparently in 3+ years of the podcast, 4.5 or however long we've been doing the live, we've answered all of the questions, Jeff. They are done, answered.
Well, here's the deal, guys. We do this show for you. So if you don't want to participate, which is completely fine, right? Nobody's man, has to put a question in. There's nothing for us to do here. And Josh and I can talk off the air. So let's give it another minute or so, Josh. And if we don't have questions, I think that's a wrap for tonight. This might be our shortest live ever, if that's the case. So 88 people watching, no questions.
They've all been educated.
All right, here we go. We got one. Hamlet. I am from California, currently own a rental property rented through Section 8 here in Lancaster. It just covers all of my cost on the house. I come out even. I'm thinking of buying a rental. All right. Still not a question, but I like it. Congrats. I mean, fantastic. If you got a property, I feel like if you got a property that breaks even, and you're in California, it's a good start, because, California, Lancaster is still one of those markets that is probably, I think long term going to see some growth because of where the price points still are relative to some of these other cities. It may seem high for people that live in Lancaster, but when you look at Lancaster prices compared to, the surrounding major metros, it's still somewhat affordable. So I think, could be an opportunity.
Jeb, you poked the bear and they've come firing with some good questions here.
All right, let's do
some
it.
good questions. Let's start with this one here. So Pink Organic Horse, if you own a rental property and price it right, but it's not moving, would you lower the price to what Zillow suggests? So we've talked about the problems with Zillow rent Zestimate and price Zestimates. But what I will say, in my experience, in all of my rental properties, Zillow is pretty aggressive on what they think market rents are. So you say you have it priced right, and you're saying, should I lower it to what Zillow is at? My last rental, our fourplex over in Long Beach, we put it at what Zillow said, and it sat. And we finally cut it $75 a month. And after 2-3 weeks, we got a good tenant in. We got lots of bad people that would potentially bad tenants, bad credit, no job, no good references, all that type of stuff at the higher amount. I err to the side of I would rather be 5% low and have my pick of the litter of the best tenants, most likely to pay me on time, take good care of my property, than have the top of the market rent and deal with frequent turnover because people feel like they're overpaying or that you owe them something because they pay you so much.
Good stuff. So 3-putt bogeys came back in, answered the question, said listed for $490, dropped to $470, and then $449. They bought it for $499. So taking a $50,000 haircut on this deal. And the main reason is they said we bought in a not so great city in Dallas, and then they're moving to Fort Worth side of Dallas. So good reasons to move. Unfortunate. Sorry to hear about the downside there in the market. I'm surprised by that because that's 3 years of you being in Dallas, and so I would have thought that the market would have been somewhat stable since then, price wise, but I guess not. So more information is good. If you have more information on why, I'd like to hear it just for context.
Let's go back to Hamlet's more information. Yep. So what he actually said is thinking of buying a property in Cleveland, Ohio, because we're looking at how much it costs and how much Section 8 pays in rent. Looking at a house that costs $100,000 to $130,000 pays around $1,500 to $1,800 a month. So let me jump in on this and then follow up with your thoughts. Cash flow is going to be better throughout the Midwest. You're also not going to get anywhere near the appreciation. I wasn't looking Cleveland. I don't know if it was Indy or Detroit. I was looking, I'm like, this is a really nice apartment building at a very, very reasonable price, until I started looking at all of the little things, their pro forma in terms of their maintenance, taxes, insurance, everything. So those can be different and higher than what you see in California. Not a problem with chasing cash flow, but just realize that we had the chart 2-3 weeks ago here on the show of what since 1980 or 85, what appreciation has looked like across the country. And I guarantee you Ohio looked nothing like even Lancaster.
All right, there you go. Is it illegal in Southern California or South Carolina, I don't know, to advertise military encouraged to apply? I like renting to them, but don't want to be accused of discrimination. I would
discriminating against anyone on that. You're saying you're encouraging people to reach out.
Sure. I still don't know. I mean, if it's you as a homeowner doing it, probably less of any sort of issue. If it were me as an agent doing it, there's probably some sort of ethics thing that I shouldn't be doing in that case. So I don't think there's anything wrong with it. I think, you're okay saying that you're willing to rent to military. I think it's a good thing that you're willing to do that, and could be your way of, quote unquote, giving back. So no, I don't think there's any issue with it, but you might want to just talk to somebody locally just to make sure on that front.
South Carolina, a heavily VA market, a lot of veterans, a lot of military installations there. So I don't think you can get in trouble saying you're supporting or encouraging anyone. You're not discouraging. I mean, what are protected classes? I don't believe, if for most purposes, for housing, veterans may fall under a protected class. But do a little research, Google it, GPT it, with citations to the actual sources, not just its opinion, and see what it thinks.
All right, here's a good one, Josh. Probably a question we've never had on the show, something we talk about often, but can you discuss how mortgage-backed securities influence mortgage interest rates? The lending practices are somewhat irrelevant here, but how do they impact rates?
So look at it this way. The gold standard, if you want a fixed income investment, you want U.S. Treasuries. They are the safest, most secure, even though they're unsecured debt it's to the U.S. government, who has never defaulted. So that is the lowest rate. So I was thinking about this in terms of today. Someone was trying to talk about who cares about the 10-year Treasury. It's mortgage-backed securities that matter. It's true, but mortgage-backed securities are sort of like a dog on a leash, and the guy walking the dog or the girl walking the dog is the 10-year Treasury. They never get too far apart. So if 10-year yields drop, mortgage-backed securities, their yields will eventually drop also. They don't get too far apart. And to the contrary, if the 10-year goes up, you're going to see mortgage-backed securities going up, because the supply and demand, generally investors prefer Treasuries. When the yields get too low on Treasuries, then they'll rotate into mortgage-backed securities and they come down, and vice versa going the other way. If you're not getting enough premium in yield on mortgage-backed securities, you're just going to go and get U.S. Treasuries. So that's the function relative to Treasuries. Mortgage-backed securities make the market more liquid. They make more money available, so they generally push yields down. If we go back 50 years before the prevalence of mortgage-backed securities, you have higher yields, less liquid loans. People would borrow more from their banks and credit unions, who actually had a loan committee and made decisions. We can talk about Jeb's favorite account executive back at World Savings and the loan committee that he had never taken the loan to.
What was that guy's name? Brett.
You can't call him out live on YouTube.
No, I will definitely call that clown out. I'd love to see. I punched that guy right in his face. God, he was awful. God, he was so bad. Anyhow, we're moving on. Matt, the mortgage guy, came in with a question. Matt's another YouTuber, mortgage guy up in Sacramento area. Exactly. And saw the last wave of bidding wars with rates starting to move up. Sounds like that might have happened to the seller bought at a premium in 2022. Yeah, I didn't think about that. But even then, I think we just got the Case-Shiller that in real prices, we're only down like 1% since the peak in national home prices. But again, we talk about real estate being local, right? Most markets are still up since 2022, whereas some markets have moved sideways to down slightly. So it could be that case, but it sounds like you just said that they're moving forward with your entire loan balance as far as an assumable loan. So good for you, man. Good. I'm glad you're able to get out of it and move to a better area for you and your family. So David says, what is my opinion on the New York Times story about realtors evading the new rules reached with the prior court settlement? So I haven't seen anything about evading it. What I did see is that the Fed did a study on the new compensation guidelines and the impact it's having. And basically what they found is that it's not impacting anything, that compensation is still being paid, and it's still being paid at a similar amount as it was prior to, and it's having little to no impact. So I'm not sure realtors are evading it. It's active here in California. We have to get them signed on buyer side, and we have to submit that when we make offers. But with that said, most of the time it's still getting paid exactly like it was before.
The crazy part, Jeb, is the belief, or the theory was that buyers and sellers are dumb. They didn't understand how it works because agents are compensated by the seller, so it's transparent to them. There's this cost that they don't see, and if they see it and it has to be negotiated and put on paper in front of them, that it's going to get negotiated differently. So first of all, what did it go into effect last August, Jeb? So we're like less than a year. You don't turn the Titanic on a dime. Actually, the Titanic sinks. You don't turn the ship on a dime. A big steamship is going to take some time, and we have seen, especially in higher cost areas, there is downward pressure. But anyone who thought that we were going from this mythical 3%, that in high cost areas like California, that we were going to go from that, which was really like 2.4, 2.5 to each agent, that we were going to go from there to 1% because people see it on paper. There aren't a lot of people willing to do the work for 1%. So you supply and demand. How many people are willing and able to do the work the way that it's been done, the way consumers have gotten used to it, and do it for that compensation? It will take time to adjust. So I think it's a little silly to be doing studies and saying things aren't happening.
All right, Josh, I'm about to jump out. You can stay in here if you want, but this question came in. It says, do you think the potential increase in the property tax deduction cap to $40,000 with the big, beautiful bill would have any real impact on the housing market in states like California? And the answer is yes, it will. But the good news is Josh and I recorded an episode that drops on Monday talking about how this will impact housing affordability and the housing market. So stay tuned. Monday it'll drop. It'll be here on YouTube, and it's a good episode. We go over, that impact and what's likely to come. So, Josh, do you want to stay on here and answer some questions? Are you?
Yeah,
good?
there's a few more here. So as long as you guys have questions, we'll stay. We've been on for an hour, but yeah,
I'm gonna tee you up here. What do you think is the mortgage rate that will trigger buyer demand? Guys, I'm out for a birthday. I will see you next week.
Happy birthday, Nashi.
There we go.
Eat some steak for me. So yeah, what do you think is the mortgage rate that will trigger buyer demand again? There's some debate on this. I think we will see an increase in demand below 6.5. When you get to that 6% range, and definitely below 6%. If we rolled back to Jeb's charts from the beginning of the show, you can see last year when we got below 6.5 and for a period of time below 6, you saw a big spike up in just contracts, people under contract. Now, big spike, did it mean we went back to 2021 levels or 2020 levels? Absolutely not. But relative to the anemic numbers we've seen over the last few years, lots of people were willing and able to step back in at that level. So somewhere between 5.75 and 6.5, and the lower it goes, the more it will increase demand. I don't think any number there gets some type of mania where you bring buyers back into the market, because if even rates drop to even 4%, you still have prices well above where they were when rates were 2.5, 3.5%. So that affordability is not going to get back to that level. Then you have that whole concept of animal spirits. Once those are gone, it's hard to get them back. So from that perspective, that's what we're looking at. Boy, oh boy. So Anna Bear, real good question here. How do credit scores influence mortgage rates and approval chances? Rates are pretty straightforward. On government loans, FHA, VA, USDA, 680 and above, definitely 720 and above, you're going to get at or close to the best terms available. So it gives you more wiggle room there. 640 to 680, you're still going to get good terms. Below 640, you start paying a premium for that. Now, conventional, you start paying a premium right at anything below 780. So 780 down to 760 to 779 is going to be a tiny bit worse. You drop down to 740, tiny bit worse still. And it's sort of like boiling a frog. It just starts eating away at it there, to the point where if you get down to, say, a 680 credit score, unless you have a very large down payment or you're refinancing and you have a lot of equity in the property, you're probably going to be looking at wanting to do an FHA loan. Always got to compare the numbers and take a look at it. But that's what you're going to want to look at. So the second piece there, how does it impact getting approved? So you have the idea of a manual underwrite or an automated approval. So Fannie has a 620 minimum. FHA has a 580 minimum with 3.5% down. VA doesn't have a minimum for practical purposes. Lenders will cut it at 500, but below 640, below 620 especially, it starts getting really unlikely unless you have some other very good things about your file, such as a ton of equity in the property, giant down payment, really low debt to income ratio, which doesn't often go hand in hand with a lower credit score. Those are the things that will allow you with a low credit score to get an automated approval. Most times you get pushed down to manual. So with the manual underwrite, you can get them approved, but you're looking at lower debt to income ratios. Sometimes you need compensating factors. So you're going to pay more and qualify for less. Other things being equal, you absolutely want to maximize and optimize your credit score. And most people are doing lots of little dumb things that they're not aware of that would make a nice increase to their scores. You see the link down below, jebsmith.net/start. You can also use the email address for the show, info@theeducatedhomebuyer.com. We put together, as part of the last webinar, about a 20-page PDF that goes step by step, the little things that you can do to maximize and improve your credit score. So if you want that, shoot an email to the info@theeducatedhomebuyer. We're more than happy to get it out to you. Joyce, this is a good one here. What are your thoughts on Trump's consideration to privatize Fannie and Freddie? All of the data that has been done leads us to believe that if they are privatized, mortgage rates for conventional loans would be about 0.25% higher. And many, especially lower credit score borrowers, more of them would get pushed to FHA loans and put the risk onto the government in the form of more FHA loans. So what the last 10 days, 7 days here, this has gained more steam. Trump has said he would like to privatize them. People asked Treasury Secretary Bessent what he thinks about that. He said, we are absolutely talking about it, but we would only consider it if it didn't lead to higher interest rates. So you're like, okay, how does that happen? So Trump, I don't know whether it's on Truth Social, wherever he put it out, or it was just a quote, but he basically said, we are not privatizing Fannie and Freddie without keeping the implicit guarantee of the U.S. government. And that is really the only way that you would be able to privatize them without seeing a spike in yields or a bigger increase there in interest rates. So important to remember there that what's the point of privatizing them if we still have an implicit guarantee? Right now, we have the actual guarantee of the federal government because they're in receivership. So interesting. It will be interesting to see how that plays out and what that looks like going forward. What do we have here? We got a couple more questions. So Pink Organic Horseback says, my last tenants left a new washer and dryer. Should I include it in the rent, free but not liable for repairs, or rent it with an additional charge? Really your call there. You could leave it there for them at no charge and let them know that if something happens with it, it's going to go away. You can give it to them. It is a gift. If you would like this is your gift on the way in. Not really a right or a wrong answer. You may, when you're interviewing prospective tenants, just ask them what is their preference, how important is it to them. So from that end, that would be the biggest piece that I have. So apparently with Jeb walking out the door, so did all of our questions. So we've been on for about an hour and 5. If no additional questions pop up, I'm going to run out the door here myself. I've got a bunch of numbers we got to get out to borrowers here before I get to go home and have my steak dinner. But looking at that, use the link below if you have questions, you want to get pre-approved, you want to see what your options are, jebsmith.net/start. If you're in one of the it's 24, 26 states that our team can help you in, but it covers about 85-90% of the inquiries that we get. We have almost all the states where most of you are located. So from that perspective, use that if you want to get pre-approved. Reach out. Hamlet has a question here. Where can I get the chart that you were talking about? Remind me which chart it is. Just send an email to info@theeducatedhomebuyer.com and then just remind me specifically what chart you're looking for. We'll dig it out. I believe Jeb still puts links to the charts at the beginning of the show. So if we were talking about the one a few weeks back, it should be there linked in the notes of the show. Raul has a question here. How much does escrow cost? It's a trick question. It varies massively depending on where you are in the country. Have won a $600,000 purchase in Florida and it was less than $1,000, but title charges are much more expensive there than other parts of the country. So there can be a very big range and there's not really rhyme or reason, and you can't say that it balances out the cheap escrow states or high title states or vice versa. When you're going through the pre-approval process, your loan officer should be able to give you a really good breakdown on that. I mean, we don't know what title and escrow company you're going to use, but we generally have access to smart fees, or we can look up sort of the prevailing rates and terms for escrow and title coverage in your area. All right, guys. Looks like we got all of your questions answered. Had a bunch of you here. Appreciate you guys showing up every week, supporting us, asking questions. If there's anything you would like to hear, go ahead and throw in the comments what you'd like us to cover. As Jeb said earlier, we're always looking for ideas to talk about on the weekly podcast episode. Anytime you have questions, show up here every Wednesday, 5 p.m. Pacific, 8 o'clock Eastern. We have at least an hour of answering questions, hopefully getting you the information you need so that you can buy right, borrow smart, and build wealth. So until next week, when we see you guys again, adios, amigos.